This is BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, February 25th, and the market's basically holding its breath for one company's earnings like it's the season finale.
Nothing says diversified economy like everyone staring at one chip company and whispering, "Please don't ruin my retirement."
We've got four stories: Nvidia's earnings test for the AI trade, a tariff headline pointing to 15% where appropriate, oil steady around $71 ahead of U.S. Iran talks, and China's Yuan strengthening to near a 3-year high.
Chips, taxes, crude, and currency, aka the four horsemen of my group chat's financial confidence.
Story 1. Stocks rose in a tech-led rebound as traders waited for Nvidia earnings, basically treating it as a referendum on whether the AI rally is still the market's main engine.
So Nvidia isn't just reporting numbers, it's auditioning for the role of entire stock market's emotional support animal.
Here's the simple finance behind it. When one theme dominates, like AI, big funds crowd into the same names. Then earnings becomes the reality check. Are revenues, margins, and guidance keeping up with the story people already paid for?
It's basically like buying a fancy gym membership because you saw one influencer's abs. Earnings is the moment you step on the scale and it says, "Ma'am, you ate nachos."
Actionable way to think about it. Use a 3-scenario checklist. 1. Beat and raise guidance. AI leaders likely rally and pull indexes up. 2. Meet expectations. Market may still sell off if positioning was too bullish. 3. Miss or soft guidance. Then you can see a broader de-risking, not just one stock moving.
I love that meet expectations can still be punished. That's like me showing up on time and my boss goes, "Interesting choice. We expected excellence."
Also watch the second-order signals: data center demand commentary, supply constraints, and whether customers like big cloud platforms are still expanding CapEx. Those details often move the whole sector, not just Nvidia.
So the earnings call is basically, are the grown-ups still buying expensive GPUs, or are we all going back to printing spreadsheets and pretending it's innovation? Where appropriate is such a polite phrase. It's like, "I will charge you extra," respectfully.
The simple version: a tariff is a tax on imports. The importer pays it at the border, and then the cost gets split. Some passed to consumers via higher prices, some absorbed by company margins, and sometimes pushed back onto suppliers through renegotiated pricing.
So it's like ordering delivery, and the app adds a service fee, a delivery fee, a because we can fee, and then you're like, "Cool, I'll just eat cereal."
Why it matters for normal people. Tariffs can show up in everyday categories: appliances, electronics, auto parts, depending on what's targeted. For investors, it's a margin story and an inflation story, and that can feed into interest rate expectations.
And the market hears inflation story and immediately starts acting like your uncle at Thanksgiving, loud, confident, and somehow wrong about timing.
Action step. If your household budget is sensitive, do a mini stress test. Pick 3 big imported categories you might buy this year: phone, laptop, major appliance, and assume a 5 to 15% price bump. If that breaks the plan, delay, buy refurbished, or set a sinking fund now.
I love a sinking fund. It sounds like a pirate plan, but it's actually just adulting with spreadsheets.
Story 3. Oil edged above $71 as traders weighed the odds of a nuclear deal between the U.S. and Iran ahead of talks on Thursday, while a large American force deployment in the Middle East keeps the market on edge.
Oil prices are like a group project where one person says, "I might show up," and everyone panics and changes the whole plan.
The simple version: crude prices include a risk premium. If traders think supply could be disrupted, prices can rise even before any barrels actually go missing. If diplomacy reduces risk, that premium can fade quickly.
So we're paying extra for the possibility of drama. Honestly, that's also my streaming subscription.
Why it matters. Oil flows into gasoline, shipping, and some manufacturing inputs. Even if you don't trade commodities, energy is one of the fastest ways geopolitics hits your weekly spending and business costs.
And it's always at the worst time. Like when you finally planned a road trip and your car suddenly becomes a subscription service called Premium Unleaded Plus.
Actionable move. If energy spikes tend to hit you, consider practical hedges. Drive efficiency, consolidating trips, and for investors, keeping portfolio exposure balanced so one macro shock doesn't dominate outcomes.
My hedge is emotionally preparing to not be the let's go out friend when gas is expensive. I'll be the let's stay in and cook profit.
Story 4. China's yuan strengthened to its highest level against the U.S. dollar in nearly 3 years, with the offshore yuan around 6.867 per dollar, alongside a firmer official fixing amid uncertainty over the U.S. currency.
So the yuan is feeling strong, and the dollar is having a self-reflection era.
The simple version. Exchange rates move on growth expectations, interest rate differentials, trade flows, and policy signals. A stronger yuan to affect import costs, export competitiveness, and the returns you see when you hold international assets in dollar terms.
It's basically like traveling with friends who all use different payment apps. You think dinner is cheap, then the currency conversion hits, and you're like, who ordered the optimism?
Why it matters for everyday investors. Currency can quietly add or subtract from returns. If you own international funds, a move in the dollar can change results, even when the underlying stocks do fine.
So you're telling me I can be right about the company and still lose money because the dollar woke up cranky? Finance is such a character.
Quick recap on 2026 February 25th. Markets are watching Nvidia earnings as the AI trades reality check. Tariff talk points to 15% where appropriate, which can hit prices and margins. Oil is steady near $71 with diplomacy and risk premium in play. And the yuan is stronger amid U.S. dollar uncertainty.
And your homework is, don't panic trade, do panic budget. Just a little, like a tasteful amount of panic.
If you want more episodes like this, subscribe and check back tomorrow. And if you're investing through volatile weeks, keep position sizes sane, keep a cash buffer, and write down what would actually change your long-term plan, so headlines don't do it for you.
Share this with a friend who texts you, should I sell everything every time a chart wiggles? We're trying to save relationships and portfolios out here.